This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 16, 2026, and this is the London session. Now, let's get into it. Markets are locked in a standoff right now. The U.S. economy is printing data that defies the chill in the air, while a geopolitical shadow looms over the Atlantic. The Fear and Greed Index is sitting at a terrified 14 out of 100, yet the dollar remains stubbornly anchored. We're looking at a market where the safest haven is also the most contested ground. Looking ahead, the calendar points to one singular flashpoint for the afternoon. On Friday, July 17th, we have monthly OPEX. But today, the real clock starts ticking at 13:15 UTC when the European Central Bank delivers its rate decision. This is the immediate catalyst. The ECB stands at a crossroads, and whatever they decide will define the trajectory for the euro against a dollar that is currently riding on the back of unexpectedly strong U.S. economic prints. Let's set the scene. The U.S. July Philly Fed Business Index came in hot at plus 41.4, smashing estimates of plus 13. Initial jobless claims beat expectations at 208,000 versus 217,000. Meanwhile, the broader sentiment is freezing over. The VIX is down slightly to 16.5, but the fear and greed gauge is deep in fearful territory. This creates a chaotic environment where strong domestic data is clashing with global risk aversion. Pulse, walk us through the tension between the Fed's stance and what the market is pricing in.
It's a study in contradictions. On paper, the Fed is sitting at 3.63%, and with CPI at 3.46% and core PCE at 3.41%, they are nowhere near a cutting cycle. That structural rigidity supports the dollar fundamentally. But look at the Philly Fed number. That plus 41.4 is a scream of resilience. It undermines the narrative for an imminent dovish turn. So, we have a higher for longer mandate colliding with a fearful 14 out of 100 sentiment score. The market is scared of the geopolitical risk, the U.S.-Iran tensions, but the data says the U.S. engine is still firing on all cylinders. That divergence is what's keeping the dollar firm despite the gloom.
And that geopolitical layer is heavy. Let's look at the headlines moving the needle. First, Iran reportedly tells Houthis to close Red Sea oil route if U.S. decides to strike power infrastructure. Second, oil prices remain skewed to the upside heading into the weekend as U.S.-Iran crisis keeps risks elevated. Third, Eurozone trade deficit widens further in May, the biggest since January 2023. CIPHER, what is the flow doing in response to this mix of threat and weak external demand?
The flows are screaming safety, but they are also trapped. You have the Iranian rhetoric pushing everyone toward gold and the dollar, yet the CFTC data shows a bizarre split. Speculative funds are piling into yen longs, adding nearly 92,000 contracts in a single week. That is an insane overcrowding of shorts against the dollar. At the same time, you have the Eurozone trade deficit widening, which is structurally negative for the euro. So, you have a flight to safety that is currently bottlenecked because everyone is trying to exit the same door. The asset managers are actually net short yen by minus 3,665 contracts, meaning the big money is refusing to join that speculative yen frenzy. They see the trap.
And that's the risk. You have a VIX of 16.5, which looks calm, but that's deceptive. When positioning gets that extreme, with 92,000 new yen longs, you aren't seeing stability. You're seeing a loaded spring. The fearful sentiment isn't just noise, it's the precursor to a liquidity crunch. If that Red Sea route actually closes, or if the U.S. strikes occur, the VIX won't just tick up, it'll gap. And when it does, those 92,000 contracts become collateral damage, forcing a violent unwinding that nobody wants to be on the wrong side of.
Let's drill down into that yen trade. Dollar-yen is currently at 162.099, up just 0.1% on the day, hovering near the top of its 5-day range, which peaked at 162.488. The technicals look tight, but the flows look explosive. Grid, what are the charts telling us at these levels?
Technically, this is a compression squeeze. We are at 162.099, which is essentially glued to the upper bound of 162.488. The 5-day low is 161.6055, giving us about a 0.5% band to work with. What's interesting is the lack of wicks. The price is sliding up the range without rejecting hard at 162.488. In a normal environment, that would be a breakout signal, but given the volume profile, it feels thin. There isn't enough absorption at the top to justify a clean breakout without a catalyst. If we don't see a daily close above 162.488, we're likely reverting to the mean around 161.8. And this is crucial. If we lose 161.6, that's not just support, that's the floor of the entire recent structure.
Grid, you're calling it compression, but I'm calling it a liquidity vacuum. You mentioned 161.6 as a floor, but look at the CFTC data. We have 1,696 net long yen contracts for leveraged funds, driven by that 91,779 contract weekly surge. That level isn't technical support, it's a magnet for stop losses. When price hits 161.6, it doesn't find buyers, it finds margin calls. The fact that asset managers are net short yen by minus 3,665 confirms that the smart money is already fading this speculation. The leveraged funds are alone in this trade. If dollar-yen breaks 161.6, that 92,000 contract pileup becomes a short squeeze in reverse, a long squeeze. The move up won't be slow, it'll be vertical.
Exactly. And don't forget the VIX is at 16.5. That low volatility is masking the fragility. The yield curve is flat at plus 0.42 percentage points between the 10-year and 2-year. Historically, a flat curve warns of growth slowdown, which usually helps bonds, but here it's squeezing the yield differential that supports the carry trade. If that curve flattens further while yen longs are this extended, the math breaks. You have a strongly bullish yen positioning from speculators, but a weak fundamental yield backdrop. It's a bubble waiting to pop on any hawkish US data print, which, remember, just arrived in spades with that Philly Fed number.
Which brings us back to the ECB. If the ECB holds steady or cuts, the euro falls, but the yen trade is separate. The yen trade is purely about dollar strength vs. Fed patience, and right now the Fed is patient. The 3.63% rate is a moat. The issue is whether that moat can withstand the geopolitical hammer blow from Iran. If the oil spike accelerates inflation, the Fed hikes, or at least stays put harder. That crushes the yen bid. But if the market panics and buys bonds, yields fall, and the yen bid strengthens. It's a binary outcome, dependent on whether inflation fears win over growth fears. Right now, the Philly Fed says inflation/resilience wins.
That sets up the euro perfectly. Euro-dollar is at 1.1466, down 0.3%. The headline says Eurozone trade deficit widens further in May, the biggest since January 2023. Grid, where is price sitting relative to the structure here?
Price is testing the lower shelf. The 5-day low is 1.13776 and we are currently at 1.1466. That's less than 1% away from breaking the floor. What's notable is the slope. The decline from the 5-day high of 1.14826 has been steady, not jagged. This is a grinding erosion of support, not a crash. The resistance is clearly at 1.14826, where sellers have stepped in repeatedly. Until we reclaim that level, the path of least resistance is toward 1.13776. And once 1.13776 goes, the next liquidity pocket is much lower. The chart doesn't lie, the bulls are exhausted on every bounce.
The flows confirm the exhaustion. Look at the broader context. Asset managers are net short RC by 37,303 contracts, and while RC isn't euro, it reflects the same risk-off rotation. For euro specifically, you have the trade deficit widening, which is a structural bleed. But more importantly, look at the DXY. Leveraged funds are net long DXY by 4,438 contracts. That is a strongly bullish stance on the dollar. So, you have smart money loading up on dollar longs, while retail and speculators are confused about yen. The euro-dollar move isn't just about Europe, it's about the DXY bid absorbing all the float. Every time euro tries to push to 1.148, the DXY longs step in. It's a wall.
And that wall is reinforced by the central bank divergence. The ECB is facing a trade deficit crisis and growth stagnation. The Fed, they have a 3.46% CPI and a 41.4 Philly Fed index. The yield gap is widening in favor of the dollar, unless the ECB shocks us with a massive hawkish surprise, which is unlikely given the deficit. They are fighting gravity. The good place comment from the Bank of England's Breeden is irrelevant here because the Eurozone data is deteriorating. The 1.13776 level is going to be tested, and frankly, the fundamental case for defending it is gone.
But wait, consider the contrarian play here. Everyone is short euro because the data is bad. The positioning is likely heavily skewed toward euro shorts. If the US-Iran situation escalates into a full-blown war scare, risk-off assets often get sold indiscriminately, including the dollar if it's viewed as part of the global financial system stress. However, historically, in a true war panic, the dollar rallies hardest. So, the euro is stuck between a rock and a hard place. If peace breaks out, euro rallies. If war hits, euro crashes with the rest of risk assets. The VIX is low, 16.5, so we are not in panic mode yet. But if that VIX spikes above 20, the euro-dollar structure collapses instantly. The current 1.1466 level is a dead cat bounce.
Speaking of panic, let's look at gold. Gold is at 4,034.9, down 0.57%. It's pulled back from highs near 4,111.96. Is this a top or just a cool down? Grid, what does the chart say?
Gold is acting like it's unsure of its role. It's sitting right in the middle of its 5-day range, which spans from 3,983.56 to 4,111.96. Currently at 4,034.9, it's closer to the bottom half. The psychological level at 4,050 has acted as resistance, causing that pullback. The 5-day low is 3,983.56. If 4,050 doesn't hold as immediate resistance, we slide toward 3,980. But notice the volume. The drop from 4,111 hasn't been accompanied by massive capitulation volume. It's a drift. That suggests buyers are still lurking at 4,000. It's a consolidation phase, not a breakdown. The structure is intact, but the momentum has stalled.
Here's the twist. Gold is dropping even though the fear and greed index is 14/100. Usually extreme fear pushes gold up. Why is it falling? Because the dollar is too strong. Remember, the DXY is net long by leveraged funds. Gold competes with the dollar for safe haven status. Right now, the dollar is winning. Plus, look at the yen trade. Those 92,000 new yen longs are sucking liquidity away from gold. Investors are choosing the yen over gold for this specific trade. The flow is shifting from precious metals to currency speculation. Until the dollar cools off, gold is capped.
And that's the fragility. Gold at 4,034 is vulnerable to a double whammy. If the US-Iran crisis de-escalates, the safe haven premium evaporates, and gold drops to that 3,983 support fast. But if it escalates, the dollar might surge too hard, crushing gold temporarily before it recovers. It's a lose-lose setup in the short term. The VIX is at 16.5, which is quiet. Quiet is dangerous for gold. Gold needs noise to thrive. Right now, the noise is focused on geopolitics and the dollar, leaving gold in the shadows. I'd be wary of chasing the bounce at 4,050 until we see the VIX expand. Without volatility expansion, gold is just drifting lower.
So, we have a dollar that is structurally bullish due to data, a yen trade that is dangerously overcrowded, and gold caught in the middle. Apex, tie this together. How do we navigate this session?
The core dynamic is the collision of crowded flow versus fundamental gravity. Grid noted the dollar-yen technical compression at 162.488, and CIPHER highlighted that the 91,779 contract surge in yen longs makes 161.6 a liquidity trap. SPECTER correctly identified that the low VIX of 16.5 masks the explosion risk if that trap springs. Meanwhile, Pulse pointed out that the Fed's 3.63% rate and the ECB's looming weakness create a wide yield gap that favors the dollar. The synthesis is simple. Do not fight the dollar trend, but respect the yen positioning. The chart says dollar-yen may consolidate, but the flow says a break below 161.6 triggers a mechanical squeeze. For euro-dollar, the 1.13776 support is under siege by both weak Eurozone data and strong DXY flows. The path of least resistance is lower unless the geopolitical risk forces a total reset. Stay nimble, respect the stops, and watch the DXY flows.
Key takeaways for the New York session. Number 1, the dollar is anchored by resilient U.S. data and strong institutional buying, despite the fearful sentiment. Number 2, the yen long trade is extremely overcrowded, creating a high-risk squeeze scenario around 161.6 if dollar-yen dips. Number 3, euro-dollar is grinding toward support, with the ECB decision serving as the final test of its defenses. Tomorrow, we watch for monthly OPEX and any shifts in that yen positioning. This is ShadowQuant Forex edition. Thanks for listening. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.